Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, and Overstock before it shot up over 1,000%. This power gauge comes from the legendary Mark Chaikin. And right now you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugetrial.com for your free look. Again, that's powergaugetrial.com for your free look. All right, let's get to our segment today. Bond yields, inflation, and recession worries continue. Here to help us navigate these troubled times is Chris Versace. He is the Chief Investment Officer over at Tematica Research. Chris, good to see you. Welcome to my show here at Stansberry Research.
Hi, thanks for having me. It's been a bit since we chatted, so I'm looking forward to catching up and dishing on the markets.
Absolutely. Now, I have a huge smile on my face, obviously, for seeing you, but we are living in some pretty rough times here. I want to talk about the recent moves that we're seeing from the Federal Reserve. We all know by now how the narrative goes, 50 basis points on the table. The Fed definitely showing that they mean business when it comes to combating inflation. What's your take on the current environment here?
I mean, there's a lot of moving pieces. You know, as I sit here today, you know, some of the forces that have been weighing on the market, and you know what they are, your viewers know what they are, you know, the Russia-Ukraine war and related sanctions, the China lockdowns and renewed supply chain issues, as well as demand issues that they're having. You know, those remain, you know, effectively in place. Inflationary pressures are remaining with us as well. You know, and I understand that the Fed is looking to, you know, really crimp on the inflation, but the real question is, are they moving fast enough with, you know, 50 basis points on the table, as Fed Chair Powell had to say, or are they potentially behind the curve? Remember, we got the unit employment cost data for the first quarter that was up, I mean, barn burner year over year. The April employment report showed year-over-year wage gains that, you know, maybe a tick down from, you know, what they were in March, but still at extremely elevated levels. The comments that we're getting, whether it's, you know, the ISM manufacturing, ISM services data for April point to continued inflationary pressures. More likely, we're going to see added price increases coming out of that. So, you know, this whole kit and caboodle is really what's weighing on markets. And I think the windup is, we have so much uncertainty in the market that bad news is clearly bad news, but even as companies report their earnings, Daniela, good news isn't good enough. That's the problem that we face in the market.
Well, exactly. You brought up the devastating earnings season, and I know you've been doing a lot of writing on, you know, there's still opportunity out there if you're looking to enter the market. But for the folks who have just been beaten down, you know, they're begging to know, you know, does the NASDAQ, does the S&P, does the Dow, does it rebound from here?
I mean, at some point it will. You know, I think one of the conversations that, you know, we're having internally is, in some respects, this is almost very similar to what we saw back in the end of the first quarter of 2020. Granted, the catalyst is very different, right? Back then we had you know, the unknowns of COVID spreading and perhaps the greatest global slowdown we ever saw. But here now, we again, just recapping them, we had a number of uncertainties and things that are weighing on the market. You know, we do have some of that spillover still with China and the COVID zero tolerance, you know, policy that they're putting in. But the big difference is we have a Fed that is going the other way. So that's raising a lot of questions. But I think what you really want to get at is, you know, what are we thinking? What are we doing? And, you know, at Tematica, we've always looked at the world from a thematic perspective. So, you know, we're looking for long-term structural changes that people can invest in. And, you know, we are seeing a number of them continue to play out. You know, digital connectivity continues to rise. That's going to continue to pressure the digital infrastructure. We like that. We think cybersecurity, which is the yin to that yang, if you will, is going to continue to be a growth vector. Not only as the number of attack vectors widen out, thank you, IoT and some other things, but as bad actors continue to develop new forms of attack, not just on the same institutions that we've seen, but really as they widen those out as well. Everything from private sector companies ranging from agricultural equipment is now in vain to be attacked, as are increasingly hospitals because of the rich amount of data that they contain inside them. So there's a number of growth areas I think that people can look forward to, but the key here is you're going to have to be patient. You're going to have to let the data talk to you, as we like to say. So,
is that a long time patience, a long term patience, short term
so I
patience?
mean,
How patient do I got to be here?
yeah. So from a thematic perspective, right, we're always looking at a rolling 12 to 24 months. But I can understand that in the near term, your listeners are going to want to go, okay, that's fine, but what do I do? How do I reposition here and now for the next 6, maybe 12 months? And what I would say there is one of the models that we have is simply called the consumer inflation fighters. And it's a basket of companies ranging from Costco, BJ's to Boxed that are really designed to help consumers stretch the disposable spending dollars that they do have. When we look at, again, the inflationary pressures that are out there, or we get data from Lending Club that says 64% of the average consumers in the United States are living paycheck to paycheck, we know there's a lot of pain. We add to that what we saw last Friday with the April consumer credit data that showed, once again, revolving credit, which includes credit cards, went through the moon. So we know people are going to feel the pain of that incremental debt. Thank you, Federal Reserve, and the 50 basis points we got, plus whatever we get, at the June and July meeting. So, consumer inflation fighting stocks, I think, are a great safe haven here, as are companies that have what we call inelastic business models. And what I mean by that is products and services that you're going to buy no matter what, Daniela. Paper products, right? Personal care products, water, not bottled water, but water from your utility, electricity from your utility as well.
Okay, let me ask you, does anything change June 1st? Because we know the Fed will begin to reduce the size of its balance sheet, i.e. conduct quantitative tightening, basically to amplify the contractionary impact of the higher interest rates.
At the margin, I don't think so. To me, the bigger drivers are, when does the war end? When does China's zero COVID policy end? And we see those lockdowns, when we see them emerge from those lockdowns. But make no mistake, though, when that happens, we're going to see a mini supply chain issue all over again, just like we saw when Europe and the United States and China at the time started to emerge from the pandemic, right? We don't turn on a dime like that. There is a ramp-up phase, and we're likely to see renewed port congestion out in California as those boats start to come in. So it's going to be a bumpy ride.
Yeah. Why do you say a mini supply chain?
Well, because when we last time had it, right, there were a number of compounded effects because it was China, Europe, and the United States all coming back online at the same time, right? This time around, it is, and you're correct, I say it's just China, but China is the manufacturing hub for the world. So you're right. It is something that we will have to contend with.
Great thoughts here, Chris. Just I want to get a thought in on the U.S. dollar. We're continuing to see the strength of the dollar here. Usually at the start of a tightening cycle, we see a weaker dollar. Why has the script been flipped now?
I think when you look at what's going on in the world, the Fed is telegraphing what they're doing. We've discussed it. The U.S. is once again, believe it or not, a safe haven, because when you look at what's going on in China and the demand destruction that's going on over there in the near term, you take a look at Europe, which is really feeling the pain of the war. They get far more energy, far more food and other commodities out of Ukraine and the surrounding areas than we do. So once again, despite everything that's going on, I think the U.S. and the dollar are the safe haven.
Do you think we'll see a recession?
I mean, the flip answer to that is sure. The real question, though, is when, right? So I think what we're seeing is very unprecedented, given the things that we talked about, the pressures that are there. If we were looking historically, does the Fed have a good track record of not tipping us into a recession despite what it's trying to do? And its track record is awful. It does it more often than not. Yet we have to remember that this is all evolving, and there's a lag to monetary policy, right? So my suspicion is that we'll see the Fed do whatever they're going to do, whatever increments they're going to do, May, June, and July, and then we have a nice pause there, and I think they're going to wait and see what they're doing.
Well, let's wrap with this with the Fed.
Sure.
Right. So they're obviously, looking to fight inflation. They want to have a strong dollar. But we're seeing the impact now on the stock market. And they were looking for a soft landing. They didn't want to rattle the stock market too much, but it's being rattled. Are they going to be able to find a balance here?
If I was a betting man, I would say most likely not. It's worse than trying to stick a gymnastics landing after hitting the bar. It's an incredibly difficult thing to stick. And again, historically, they haven't done that. They tend to overshoot. Again, that lag with monetary policy makes it very, very difficult. So I'm not as confident that they can do it.
Chris Versace, always appreciate you coming on. Thank you so much.
Thank you.
And thanks for watching. We'll have much more coming your way on Stansberry Research. And don't forget to sign up at DanielaCambone.com to stay on top of all the latest interviews coming your way. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.